I just gave you an introduction to who I am, so let's get started. So why is this not a bit? There we go. Hold on one second, guys. I think I went through a slide. All right. So in order to understand mortgages today, it's important to understand how we got to where we are. And I want to talk to you just for a few moments about the mortgage meltdown, because to understand where we are today, you really have to understand what happened in 2008, from 2000 to 2008. And it's crazy for me to think that that was already like 20 years ago, that the mortgage meltdown took place 20 years ago. But the reason I want you to understand it a little bit is because it did have an impact, obviously, on the real estate markets. Even today, what we're seeing can date back to some of the unintended consequences of how we recovered out of the mortgage meltdown. But more importantly, it's important for you to understand it, because how many times, by a show of hands, have you had a customer tell you recently, a buyer, they're just going to wait for the next crash, right? So understanding what happened in 2000 to 2008, and then 2008 to 2018 in Connecticut specifically, is important so that you can have conversations with your buyers who are waiting for the next crash to come, so that you can talk to them with deliberation and with specific facts, so that you can educate them on the fact that there's not going to be another mortgage meltdown. So let's talk about it. In 2000, there was a variety of things, and I'm going to whittle this down to just a couple points, because we could talk about the subprime crisis, the mortgage meltdown, and the Great Recession for the whole 2 hours and then some. But what's important to understand is that in 2000, the mortgage industry started loosening up its standards at the same time that we were seeing a robust housing market throughout the country. So the combination of going into a robust, we had a solid economy, we had a robust real estate market, and then coming into that with the mortgage industry deciding to loosen up their credit standards and be able to lend more money. And there's all sorts of laws and politics behind why that happened that we won't get into, is what kind of created this frenzy, similar to what we're seeing now, but different in real estate. Okay. We had at that time, the mortgage industry, and I shouldn't say we, because I actually didn't offer these programs, came out with subprime mortgages. And subprime mortgages were, you've heard about them: no income, no asset, no credit scores, no verifications. If you were breathing, you could get a mortgage. And what happened in this frenzy is you had a lot of people buying homes who could not afford them. Partially, that was it. There were two reasons why that happened, and I'm not going to weight them, but I'm going to give you both reasons because I lived through it. Partially, it was because all of a sudden we had consumers who felt like they were entitled to these loans. And secondly, we had predatory lenders who were taking advantage of disadvantaged clients and putting them in loans they couldn't afford. So the combination of those two things created a frenzy like we've never seen before. We had people buying multiple investment properties. It wasn't unusual for a buyer to walk into a brand new condo complex and buy 5 of them as investors. No income, no asset. The money was flowing. People were taking the money, and away the market went. Well, the challenge that we saw with that is that, and again, this is a slide I don't usually spend a lot of time on, but we're going to spend more time on it today because you are hearing this today. So what happened was the subprime lenders, what they were banking on was continued appreciation in the real estate market. Now, the reason they were banking on that is because the subprime loans were adjustable rate mortgages, usually set for 5 or 7 years. And the main intention behind lending this way was that the subprime lenders knew that they would just refinance those customers 5 years later, 7 years later. But what no one predicted, although they should have, is that in a strong economy, that philosophy may have worked, but our economy was starting to move into a recession. And we were starting to see higher unemployment rates. And guys, the first thing that's going to talk about mortgage quality, the first thing that's always going to be the driver in mortgage quality is employment, okay? So our unemployment numbers started to go up around the same time. Don't quote me exactly because I'm not giving you the specific timing on this, but around the same time that these subprime mortgages were coming due, property appreciation had stalled. So now this refinance opportunity that everybody was banking on went away, and the mortgages started going into default by the millions, okay? That housing crisis created a bigger recession. More people became unemployed. More unemployed people were then forced to default on mortgages, even if they weren't in a subprime mortgage. Guys, if they were in a subprime mortgage, but all of a sudden they've lost their job, they can't afford to make their mortgage payments. Now the mortgage, you can't afford to make your mortgage payment. That loan's going into default. That loan is going into foreclosure. And then a third subset of that was you had people who had bought at the height of the market, watching property values decline as much as 50 to 75% in some markets, knowing they're never going to get their money back. They're feeling like they're never going to get their money back. And we didn't see that as much in Connecticut. We saw some of it, but we didn't see as much of it in Connecticut as, like, let's say Arizona or California or Texas, where you had like a housing development with 2,000 houses, all the same, cookie cutter the same, and you bought your house for $500,000. All the foreclosures started hitting that subdivision, and the next thing you know, they're hitting the market as foreclosures, selling for $200,000, $250,000. So we had a lot of families make a difficult decision, and I'm not going to judge them. You may, but I'm just giving you the facts, made the decision to go into strategic foreclosure, get out of the house. Basically, they're sitting on a $500,000 or a $600,000 mortgage, and the house is now worth $200,000. There were strategic foreclosures. And this just continued to spiral essentially out of control until we saw the bust that we saw. I was just going to make a point about that. See, I get so excited talking about this. So, this is what I wanted to say. So one important piece of data that I want you to know, and I'm going to send this presentation out to you guys after the class, probably on Monday, but one important piece of data that you need to know to present to buyers today who are worried about a crash, okay, is that during the subprime meltdown, we had 10%, we were close to 10% unemployment. Where today we're in like roughly we're running between 3 and 4% unemployment. 10% unemployment. And then in addition to unemployment, we had another 9% of underemployed people, meaning they've been laid off, they went and got a part-time job, but they still didn't have enough money to make their mortgage payments. So if you put those two statistics together, essentially you're at 20%, which means 1 out of 5 American households could no longer afford to make their mortgage payments. It was catastrophic. It was catastrophic. Now, if you're following the financial markets at all, or you're following the economic markets at all, you know what we're dealing with now is inflationary unemployment, right? You've been to restaurants that had to close. You've tried to go through and drive through, and they're closed because they can't find help. We have we're at a record pace of employment right now. And all of the changes that the Fed is doing is to try to cool that hot employment labor market down. So there's no correlation or no connection, both of those, correlation and connection, between what happened in the 2000s and what's happening now. The second thing that happened, obviously, during those times were the actual subprime mortgage loans. And the big difference, which continued, the subprime mortgage loans and the collapse of that part of the mortgage industry just kept driving unemployment. Kept driving foreclosures. And of course, it's the foreclosures that create the crash. Well, the reason that subprime mortgages were so risky is because we had very loose credit standards. After the subprime mortgage crisis happened, we had Chris Dodd and Barney Frank, Connecticut and Massachusetts, come together, love them or hate them. Again, I'm not judging, put together the most sweeping financial reform the financial services industry has ever seen. And it is much harder today to get there are some new products emerging that are no income verification, but there's a lot more bumper rails around how those programs will work. And it made it a lot more difficult for lenders to offer mortgage standards that didn't meet government requirements, okay? So to understand that today's lending environment is heavily regulated, huge penalties, fines, and what's called additional covenants. Additional covenants are representations that you make to Fannie Mae, Freddie Mac, HUD, everybody who's buying mortgages today, everybody who owns the mortgage ultimately. And a covenant is a representation you make. And so now lenders are have been forced over the last number of years to provide additional representation about how much due diligence we've done on that file, okay? And what this did is obviously create more restrictive lending and perfect documentation. So I always tell people that getting a mortgage today is a two-part process. The first is, can the customer afford the mortgage? And that's what we're going to talk about a little bit today as we go through all the various components of getting a mortgage. But the second thing is the documentation perfect? Because if the documentation is not perfect, then those agencies can come back to us and force us to buy a loan back, which is incredibly expensive to a mortgage lender. So if you're like, let's talk about Barbara or Christina, because they've been in the business so long, you may come across a mortgage lender today, literally today, Friday, who's asking for a document that maybe you've never heard of before. Your buyer tells you, this is what my lender's asking for. And you say to yourself, I've never heard of anybody asking for this. Maybe they don't know what they're doing. But the reality may be, and some of that is true, there's a lot of lenders who still don't know what they're doing. But the reality is that that's constantly changing. And it's changing more frequently than ever because we've got artificial intelligence evaluating the performance of loans once they go into servicing. So the hot button, just to give you perspective right now, the hot topic in mortgage underwriting is people who are on variable income. And what variable income is, and we'll get to the slide in a little bit, is when somebody's not paid a salary. So if you're paid an hourly rate and one week you work 38 hours, and the next week you work 36 hours, and the next week you work 42 hours, that's considered variable income. And when we get into variable income, how we calculate income has become very strict, because what we've seen is increased delinquencies since the pandemic of loans that were written with buyers who have variable income. So the way that the industry responds is to start really kind of making a more conservative approach to how we're underwriting these loans. So this is constantly evolving, it's constantly changing, and just begs, the insistence that I have that you work with a mortgage lender who really knows what they're doing, so that you don't get caught into some of the misinformation and situation. Anybody who's been in this business long enough has been with a mortgage company where it did not go well. They did not know what they're doing. And what's really important is for you to get your customers, especially those with variable income right now, into the hands of a lender who knows what they're doing, because it can really create problems for you at the nth hour. So I just said that to you, right? So today it's a two-step process. The ability to repay the loan, income, credit, debt, assets, and properties, property condition, property value, whatnot, and then the documentation must be perfect. Does anybody have any questions on the subprime crisis as it relates to how the market is today before we go forward? I'm going to open the chat so I can see it. Any questions at all?
Nothing in the chat.
Okay, great. Thanks, Rach. Okay. This moves so slowly today. All right. So one of the rules that came out of that Dodd-Frank law, and I'm not going to get into this too much with you, it was a ruling called ability to repay. If the ability to repay now means that the government has told lenders what we need to do to prove or to validate that a customer can afford the loan. And if we don't follow the government rules for the ability to repay, then essentially a customer can claim they should have never been given the loan in the first place, and can be released from the liability of that loan. So you can imagine the due diligence that this law created and the expense and the stress and tension on the industry that this new law created. This came out in 2009, I believe, forcing lenders to document files in a particular way so that they meet the ATR or the ability to repay rule. And what happens with ability to repay is we're layering risk, meaning we're looking at all the pieces. And this is important to understand because you may have someone who's got, and this is the one I hear the most. My client has $1 million in the bank. They're only looking to borrow $500,000 and you're giving them a hard time about their income. And the answer to that is yes, we're giving them a hard time about their income if they don't have income, because the ability to repay rule requires that we prove all of these things are stable and solid and have not only a history of seeing these things, but that we're going to be able to see them in the future, and that we can't just look at one piece. So things like credit scores, income and debt, which are known as your qualifying ratios, employment history and continuance, assets and property. We're looking at all of those things combined, and then the new automated underwriting systems have weighted those in different measure and coming out with whether we can get that loan approved or not. And ultimately, it's about what that automated underwriting system comes back with. And then we as lenders have to validate or verify that everything we put in to running that approval is actually true with the documentation. So let's talk about credit for a minute. So credit, it's important to understand that credit is a demonstration of a willingness to repay debts, a willingness. So what does the credit score impact? It impacts interest rates and PMI rates, mortgage insurance rates. Mortgage insurance is the insurance that a client pays the lender anytime that they put down less than 20% on a home. And we'll talk about that a little bit more later, but it really impacts underwriting. So I haven't updated this slide in a while, but I do want to tell you that at this point, a poor score, according to mortgage underwriting classifications, is probably more like a 680 right now and below. Credit standards have tightened up in the last couple of years since the pandemic. We can lend with scores down to 580 if there are other, if there's other strength within the file to compensate for that. Good scores really run from 680 to 720, and excellent scores run from 720 and up. So again, you might hear from your buyer, oh my gosh, the lender, I can't get approved. And you're thinking to yourself, well, I just had a customer get approved last month, 2 months ago, kind of the very same situation. I can't understand, that customer got approved with 10% down and you can't get approved with 15%. I don't understand. Chances are pretty good that this other borrower has a lower credit score. Credit scores are the #1 weighted factor that we're looking at, that the automated underwriting systems are looking at when we look at it, because it's a willingness to repay the debt. And just to give you perspective, according to HUD, FHA loans, which are a very important loan that we need in the real estate and mortgage industry for first-time buyers, especially, if a client has a credit score under 640, they are 4 times more likely to become delinquent or go into default. Right? So that just gives you perspective from a lender's standpoint when we're underwriting risk. And if a customer becomes late or goes into default, it's very expensive. It's not good for the lender. It's not good for the real estate industry. So we're constantly underwriting to risk, okay? So when we're looking at FHA loans with credit scores from 640 and under, that's where I said we're really looking at some additional, we need additional offsetting, compensating factors that would give us a reason why it would be okay to lend despite this score. Let's talk about derogatory credit. This is one of those slides where I usually get a lot of questions, and it's a good check to make sure everybody's still awake. So derogatory credit can mean different things, and how your credit score is impacted can mean different things. So derogatory credit is past due accounts, collection accounts. So past due means, uh-oh, I forgot to pay my Victoria's Secret credit card. I didn't see the bill come in. It's 30 days past due. I pay it and I get a little ding on my credit report because I had a late payment. Collection is, I had a late payment on my Victoria's Secret credit card. I don't pay it. I don't have enough money this month, or I'm not paying attention, and it goes into collection, meaning Victoria's Secret has hired a collection agency to go out and try to collect that debt. All right. And then the final is profit and loss. That's the third stage of a piece of derogatory credit, where the creditor, the credit collection company, is not able to collect it and they write off the debt. Of those three things, the thing that's most important for us to understand in lending, and for you to understand as a realtor, if you're working with a buyer who is very open with you about the fact that they've had credit blemishes, you want to get them in our hands as soon as possible. Because one of the biggest, most tragic mistakes that people make is that they think they're going to clean up their credit themselves, and they start paying off certain debts thinking, of course, I had a collection account for $50 5 years ago. I should go pay that off, when in actuality, that's going to tank their credit score. So what's important to know about collection accounts in particular is the longer somebody has a collection account, the least amount of weight it's given to the credit scoring. So if somebody has a collection account that's 5 years old, and it was for $50, it's having virtually no impact on their credit score, because timing and date of activity is what triggers credit scoring. So if somebody goes back now and pays that $50 collection, which was basically silent in the background of their credit report, it becomes active again and it tanks their credit score. I've seen $50 collections paid off by a buyer thinking, and this happens a lot, which is why I'm telling you this, because you're going to hear this. If you've got somebody open with you about their credit report, you're going to hear this. They think they've done a great job, and their credit score just dropped 100 points. 100 points. It took them from having average credit or mediocre credit to terrible credit. So please, if somebody mentions to you they're working on their credit, or I have a little work to do on my credit before I'm really ready to start looking, you need to hit the timeout button and say to them, before you do anything else, you need to talk to my lender, and make sure you're working with a lender who has access to credit simulators and can run somebody's credit and do all the important work that is needed up front to make sure they are correcting their credit in a way that's actually going to help their score and not hurt their score. That's one of the tips I can tell you on this slide. That's just so important. A judgment is typically a lien that's being placed against you. So it might be an IRS judgment. It could show up as a home equity line you didn't pay that's been levied against you as a debt that doesn't get written off. It's going to stay with you forever. So the reason we're less worried about something that's been written off as a profit and loss, candidly, is because that creditor will never come back to you for that debt. If it's written off as a judgment against you, they have the right to collect that to infinity and beyond. So judgments and profit and loss are looked at very differently. Now, to a customer, especially if they're using a lot of the online internet tools that are out there, they may not be getting the correct information, and they may not understand the distinctions between a profit and loss and a judgment. So again, time out to your customers who mention credit challenges, and make sure they get with us as soon as possible. Then you have things like a short sale. So after the subprime mortgage crisis, guys, guess what? Most houses that were selling had short sales. What's a short sale? This is when your property goes on the market for less money than the mortgage you owe on it. And then you're working with the current lender to determine what they're going to do with that gap. Now, the good news is, based on the robust appreciation we've had in Connecticut the last couple of years, I can't tell you the last time I saw a short sale. Okay. Thank goodness a lot of our equity came back, especially to Connecticut, and we have not seen short sales, but they were very common back after the subprime crisis. Foreclosure is exactly what it sounds like. Somebody was not able to meet their obligations to pay the mortgage, and the lender has decided to foreclose and repossess that property. And then you have bankruptcy. Now, what I want you to have just a working knowledge of, because again, we know so many of your buyers are so open with you and you've established these close relationships. We know they talk to you, and I just want to arm you with enough information so that you know when you need to get us involved. So foreclosures and bankruptcy are two different things, but to the average homeowner, to the average consumer, they think they're one and the same. And I can tell you this without a shadow of a doubt, because living through the post crash of the subprime industry, I talked to hundreds of clients who thought that once their bankruptcy was filed, their foreclosure was enacted. And that is not the case. And that is especially not the case in Connecticut. And you want to circle that. Connecticut is one of 5 states that are different than the rest of the country. And what I mean by this is this. So somebody goes into a bankruptcy and they put their mortgage in the bankruptcy so that that debt is discharged. They're no longer responsible for the debt. That does not mean in Connecticut, which is a judicial foreclosure state, that the lender automatically forecloses. That doesn't happen. The foreclosure piece is the title and the ownership to the property and when the bank takes that back. The bankruptcy discharges the debt, but when the foreclosure is actually executed, can be different. Now, for those of you who've been in the industry a long time or you've been interested in real estate a long time, you may have heard stories about after the subprime mortgage crisis where somebody stayed in their house for 5 years and never had to make a mortgage payment. I wish I could see, this is why I love doing this in person, because then I see everybody who's shaking their heads, yes, yes, you know, stories like this. And we saw it. And that's because it's very, very hard for lenders to foreclose on homeowners in the state of Connecticut. It can take many years, not typically 5 or 6, but I've seen it. But if somebody, even the person who says willingly to the lender, I'm willing to give you back the title right now, it's probably still a 12 to 24 month process. Okay. So if you hear somebody or somebody says to you they had a foreclosure or they had a bankruptcy or they had both, you want to get them in touch with us as soon as possible, because the waiting periods, how long before they can buy, they have to wait before they buy another house, are completely different if they had a foreclosure versus just a bankruptcy. Okay. So those waiting periods can be anywhere from 2 to 7 years. So that obviously going to make a big difference on whether that client can work with you to buy a house. And I want to save you the heartache and the gas money and everything and the stress in this market. We're trying to get a buyer who's not outside their waiting period yet for foreclosure to make sure that we're there. Now, the good news is most of the foreclosures in Connecticut we're timing out because of when Connecticut came through the end of the housing crisis. So we don't see a lot of this, but it can still kind of rear its ugly head and nip you in the behind if you're not paying attention. So again, the way you solve this is have an articulate conversation. There's waiting periods for these things. They're different. And you need to talk with my mortgage lender to make sure that we've got you in a good position. Credit repair can make a difference. It can make a huge difference. We are one of the few lenders that will actually do minor credit repair and run simulators for people. We've been able to increase people's scores within 30 days, 150 points, because sometimes it's just a simple little fix to create an improved credit score. Simple little fix. One of the most common is credit utilization is a big piece of credit scoring. And see, I can't remember where I have these on slides, so I often talk ahead, but how much credit you're using combined with how much credit you have available is another big weighted piece in credit scoring. And what I want you to know is that if you have someone who was really financially savvy, closed out all their credit cards and transferred those balances, they closed those accounts and transferred all their balances to one card with a high utilization at a 0% interest rate, chances are pretty good their credit score dropped. The solution to this, and this is what we tell people, is you don't close those cards out that you're transferring the balances to, you keep them open because that helps your credit utilization score. So there's a lot of little things that happen where homeowners and home buyers can misstep on what they need to do to improve their credit scores. And again, you want them in the hands of a great lender. Okay. So one thing I want to tell you about, and actually we're actually fighting this through Congress right now, is have you ever had a buyer that says, oh my God, I went to my lender and now I'm getting called from every lender in the universe that that they want to help me with my mortgage. And there's a lot of confusion with buyers because what they think is happening is they think the lender they went to sold their information. And the reason I want you involved in this is twofold. One, that's not true. It's the repositories, the credit repositories, who are actually selling the leads. They're called trigger leads. So we pull from Experian and Equifax and TransUnion, and then TransUnion makes the decision to sell that data to any company who's willing to purchase it. So it's not the lender who's selling the information. There's no reason for the client to distrust the lender they chose. It's happening from the credit repository level. Now, the way we can solve this right now is that when you start talking to a customer, the first thing you want to advise them is to go into the credit opt-out program. And I can send you, oh, it's right here. So it's called opoutprescreen.com. Right when you start working with them, this is the best piece of added value you can give to your buyers is go in, opt out of trigger leads. You want them to do that immediately because it can take time, a few days for this to take effect. And so when you just start working with them and you have your first preliminary conversation, even if you're selling a house and that seller is going to be a buyer, this is a great thing that you can offer them that adds value to your services that's going to help them. And it's a couple things. One, it is for you, your clients are disgusted by the amount of phone calls they get. And then occasionally your clients are going to get lured in by a lender who does not know what they're doing. And instead of using perhaps the lender that you know and trust is going to get the job done, especially in this market, they're going to wind up going to a client, to a lender who bobbles the deal, doesn't get the mortgage contingency done on time. And we know that we still have in this market, it's a seller's market. Sellers are not required to extend the mortgage contingency. And if you presented a pre-approval letter, let's say from PrimeLending, where the listing agent knows and trusts us, and trust me, this does happen all the time. I get calls all the time from listing agents saying, Kelly, we went with your buyer because it was you doing the mortgage and we knew that it was going to work out perfectly. And now all of a sudden you go in and say their lender is Internet Bank 123 and they need a mortgage contingency. It's not uncommon for the sellers to pull out and take the backup offer that's sitting behind. So don't put your clients at risk of this, and just make sure you give them the advice and the strong suggestion to go to www.optoutprescreen.com. Okay, so that's something that you can do. That's like a tip in this market that can help your buyers and can help you save a lot of headaches. Let's talk about income. So income demonstrates the ability to repay. Credit is the willingness to repay your debt. Income is do you actually have the ability to repay debt. And let's talk about qualifying ratios. So if you're like a mortgage nerd, and I've got a lot of my realtors who send us business who are mortgage nerds and they know all the mortgage lingo, you're going to hear qualifying ratios called DTI. That's the most common language today. What's their debt to income ratio? And you'll also hear what's called front end and back end. So I'll explain what all this to you is, but you should know that up until the year 2000, we had to manually, as loan officers, run the ratios by hand, and those ratios were 28-36. And what I mean by this is this. The 28% was the ratio that your housing payment, total payment, principal, interest, taxes, flood insurance, condo fees, whatever goes along with that housing payment, could not exceed 28% of your gross monthly income. If any of you ever heard the old expression, when you're going to rent for the first time or you're going to buy a house, make sure it's only 1 week's paycheck, that's where this comes from, is that essentially we want to make sure that your total out-of-pocket expenses for your home back then did not exceed 28%. And then the back end ratio, the 36, was we're going to take a look at that housing payment that we just talked about, and we're going to add in any other debts that come up on the credit report: car loans, student loans, even debts that aren't reported. Every once in a while, we'll find somebody who has a car loan and it's not reporting. So it's not just if it comes up on the credit report, we'll find it on the pay stub and an automatic deduction perhaps. But any of those debts, student loans, car loans, credit cards, alimony and child support, all those other types of debts should not exceed 36% of the gross monthly income. Then in 2000 to 2008, I say anything went. So we saw loans getting written with qualifying ratios of 100 and 100. They did not make any money, could not show that they could afford to pay this loan, which is why I didn't do them, because I was trained the old way. And I kept asking families, like, so explain this to me right now, if you will. You currently have a credit score of 600. Your current housing payment is $1,000 a month. You pay $1,000 in rent. You've got all these late payments. You haven't been able to save anything in the bank, but now you believe you can afford a $3,000 a month mortgage payment. And a lot of times their answer was yes. And I just could not wrap my arms around the idea that I was going to put a family into a home that they weren't going to be able to afford, which is why I didn't do subprime mortgages. After 2008, everything pulled back. And basically now this is how we look at it. If we see that somebody's back end, that debt to income ratio, is under 38%, we consider that they are conservatively qualified. And this is important to know because we will have these discussions with buyers. You may sometimes see a buyer who says, oh no, I can't afford more than $2,500, or I can't afford more than $3,000 a month. And we'll sit down and do their ratios and find out that their total ratio is 25. And I'll say to them, listen, you may not believe that you can afford more than whatever your comfort payment is, but from an underwriting perspective, I want you to understand this is incredibly conservative. And it's not my way to try to talk them up to a bigger mortgage payment, because everybody being comfortable should always be our primary concern, but it does give them perspective. And sometimes it just takes enough pressure off of them to be able to reevaluate their finances and their budget accordingly. Today, 38 to 43 is considered acceptable. When we get to 43% on a back end, we know that that family can, and this is all based on the analysis and trend and performance that we see on loans that we've been servicing now for the last decade. Once you get to 44 and up, I call that stretching. Now, that doesn't mean we won't do it. You're going to hear about loans that we've approved with ratios of 58%. But I'm going to tell you that you want to be working with a responsible lender who's going to have an important conversation with that buyer really about what affordability looks like for them. The reason that we go higher, okay, is because there are times based on our underwriting standards that people have income, but it's just not income that we can allow to qualify. So you might have a self-employed buyer who's not showing all their income on their tax returns, but you can tell by their assets and by their deposits that it's there. You want to have those higher ratios available to you for those cases. Or maybe you're going to sell a home to a husband and a wife, and the husband has some credit challenges and the wife has strong credit. So we're going to qualify the wife on just her income and take the husband off the loan. You want those qualifying ratios that we can stretch, because I now know there's a whole nother amount of income coming into that household. Okay. So you want to make sure that your lender isn't just, and when you go to the online lenders, these are the conversations they're not having. Okay. I took a phone call in 2000 from a client who had just closed with one of the biggest lender in America. You know, they've got spaceships that go to space. And she called me the day after she closed and said, I can't afford this payment. I can't afford this payment. And I ran the numbers and she was nowhere near where her comfort payment is. She called them the next day and literally said, I've already secured a new rent, take back the house. So people do get into situations, and that's an extreme example, but that's as recently as 2000 that I took that phone call. So there are people who get into this. And as much as we want to sell houses and sell mortgages, We want to make sure that that customer is comfortable and happy, and that they're going to return to us every time they want to buy a home, or that they're going to tell their family and friends to use you as a real estate professional, me as a mortgage lender, so that our businesses can remain vibrant by giving them good advice. So, make sure that you're doing a really good job talking affordability to people. Always when it comes to income, we must demonstrate that they have a history of it, and we must demonstrate that the probability for it to continue is high. So that's really important, because if you have somebody who comes to you and says, "Oh, I'm so excited I can buy a house. I bought a new business a year ago and I'm killing it, and I'm ready to buy a house," self-employed borrowers need a 2-year history before they can qualify for a traditional loan. So that history is important. Similarly, continuance is important. It's not unheard of that we're processing a loan for someone and we call their employer and find out they've announced their retirement. They're applying for a loan on the house that they're going to retire to. They've already given their notice to the employer, and now we don't have a continuance to use that employment income. In that scenario, we can often save the loan, because we'll then start digging into what their retirement assets are and how they can qualify on retirement income. But there have been cases where someone has said they're retiring, but they haven't applied for their retirement assets yet, and we can't verify them, and therefore they have to wait before they can buy a house. So all these little things that you have to know to make sure that we're able to continue forward with your important transaction. Any questions so far? Quiet?
Nothing in the chat.
All right, guys. Give me a little thumbs up or something if this is interesting to you, or if you want me to move on. Employment, what types of income can we use to help qualify a buyer? Employment, second job, commissions and bonus, business income. All of those income that I just told you, they need a 2-year history of having it. Now, the only exception to a 2-year history on employment is if they just graduated from college, or they just came out of tech school and they've been able to get a position in their field. In those cases, you are able to not have a 2-year history. We do loans all the time for I was gonna say kids, but people coming out of college, they've secured their first job, they have an offer letter for their new job, and we're able to use that offer letter depending on the timing of their start date to help them proceed with mortgage financing. We're able to use rental income on investment properties, net rental income. So if they're writing off a lot of expenses and they're showing big losses, those losses also get added to their debt to income ratio. And we can't ignore it. Sometimes people say, well, just don't put it on the application. Trust me, lenders do so many background checks now. We're going to find it. We have a report that we pull as soon as we take a loan in, and it tells us if any property that's currently owned in that buyer's name. So we're going to find it. So we don't have an opportunity to ignore it. You're going to want to make sure that your lender is using their investment properties in their qualifying calculations. Alimony and child support income we can use if there's a 3-year continuance. They've got to be able to continue for 3 years. Now, in the state of Connecticut deems 18 years old as the mandatory maximum date for child support. Now, you can have a couple where the spouse has agreed to pay child support until the child is out of college, but because that's not enforceable by state law for this type of income, we literally go to 18. So again, not uncommon. I get a divorce decree. We do need to see the divorce decree to verify that income. We pull it up. I see the ages of the kids, and now I can only use half the child support income or a third of the child support income and not all of it. We've got to look to ways to qualify that buyer in spite of that difference. Interest and dividend income for people who got large amounts of assets and they're making money in the stock market, et cetera. We are able to use Social Security and disability income to qualify people. We're able to use retirement income, Social Security, pensions, retirement assets that they're getting as they retire. We're also able to use assets. So if we have somebody who's of a retirement age, say they're 62 years old, and they're sitting on a large amount of retirement assets, but they're still working. But maybe they don't quite qualify for the mortgage. we can look to those assets without them having to take a distribution and actually help them qualify. And we do that all behind the scenes and you don't even know it's happening. So there's a lot of ways when you're working with a reliable loan officer who knows how to find income to be able to help somebody qualify for the mortgage that they want. And remember, I talked to you about the clients who felt like they couldn't afford a mortgage payment, but in actuality, we could give them more. Similarly, it's not uncommon to have a client who tells us that their comfort payment is $3,000 a month, and yet we can't show enough income to even get there. And so you've got to know somebody who can look at all the various types of income to be able to extrapolate as much income as possible to be able to move forward with that buyer for you. Great. Is there a couple questions in the chat?
Oh, you got a thumbs up and a heart because your explanations are so excellent, Kelly.
Thanks, guys. Thank you. All right. Let's see. So, employment, we want stability, history, and continues. They can't have multiple jobs with a 2-year history. We got a loan approved not too long ago from a client in New York City who had a history of working 2 40-hour-a-week jobs. We were able to verify for 2 full years, this man worked 80 hours a week. We were able to use the full income. Part-time jobs and self-employment. These are all the types of employment that we're able to look at. What debts do we need to take a look at? And I want to go back to that previous slide. So remember I talked to you at the very beginning about variable income being the current hot button right now. So an unintended consequence of this new variable income scrutiny that's happening by Fannie Mae, Freddie Mac, it's on conventional loans, which we'll talk about, is that interestingly enough, the population it's hurt the most are traveling nurses. So traveling nurses, their income is variable, right? It's all over the place. And you can have somebody who became a traveling nurse 3 years ago, and maybe they had a 4-year-old and they liked being a traveling nurse, and it's because of the way they could work childcare out, and then the child went to school, and now they're working a lot more variable income. Depending on when all those changes in income happen, we may not be able to use the increased income. So that's an example of a particular employment sector with variable income that we're seeing that we have to really scrutinize more closely. So if you have somebody who is a traveling nurse, we want to get them in our hands as soon as possible. And it's a growing industry. So many nurses now are leaving traditional medical positions for traveling nurse because the income is amazing. It's so much more than they could make working at, let's say, your local hospital. But again, from a qualification standpoint, it's going to be, we're going to need to look at that very, very closely. So what kind of debts do we look at when we're running those debt to income ratios? Mortgage, what their current mortgage is, any mortgages that they have on, if they have a second home, they've got a house on Martha's Vineyard, we're going to take the total payment of that mortgage. If they've got mortgages on investment properties, like I said, we're going to look at the tax returns and evaluate the net interest, the net rental income. But current mortgage today, in today's market, we're seeing a lot of people who want to buy their next house before they sell their current house, right? Because everybody's afraid to put their house on the market because the lack of inventory. Where are they going to go live? And we are constantly evaluating, can they afford to carry both mortgages at the same time? And if not, what can we do to help them qualify for it? Auto loans, auto leases, minimum credit card payments. So whatever the credit report shows is the minimum payment, that's what we're going to use. Unless it actually occasionally we'll see a very large payment due on a credit card. If we can get a copy of the invoice, the bill from the client, we can actually drop that down. So again, got to know to do that extra work to help somebody qualify. Personal loans, student loans. So student loans are a hot topic only because mortgage guidelines changed on these about 5 years ago. So 5 years ago, if you had a deferred student loan payment, we did not calculate it in your debt to income ratio. And frankly, guys, that helped a lot of people qualify, but it wasn't the proper approach because eventually you have to start making those payments, correct? And we're now seeing some of that fallout from all the deferred, interest-free deferred loans that people with student loans got during the pandemic. But when we're looking at student loans, if we see somebody who's got student loans, let's say we're dealing with, I don't want to say a child, but let's say we're talking about somebody whose parents co-signed the student loans for them or didn't co-sign them, we'll ask them, who makes these student loan payments? Not unusual for someone to say, my parents make those payments. I've never had to make the payment. And in that case, we'll go back and verify that the parents have made 12 months worth of payments, and we won't have to count that debt against them. Similarly, if parents are carrying student loan debt in that case, and they did co-sign for the student loans, we do have to count it against the parents when they go to buy their retirement house, let's say. And this can create some problems because parents didn't realize this was going to be held against them that way.
We do have some questions in the chat, Kelly, about working after retirement and traveling nurses.
Okay, so what are the questions?
So Kim would like to know, how does age affect qualifying if someone is working after retirement and has good income?
It doesn't affect them at all. I did a loan last year for an 84-year-old Korean War veteran. We can't discriminate on age. If it's income that they've had and they show a history and a continuance, we get to use that income. But in that particular gentleman's case, he was sitting on a lot of retirement assets, and that he wanted to buy a much bigger house. He was living in an apartment in New York City. He was a veteran, as I just told you. He wanted to buy a much bigger house because he wanted his daughter and adult grandson to come move in with him and essentially take care of him. But he didn't show enough income, but because he had all these retirement assets, we were able to extrapolate how he would be able to access that income. Because of his age, you can start taking disbursements against that if you want. We're able to get additional income for him to help him qualify. So Kim, let me know if that doesn't answer your question. Rach, what's the next one?
And then Christine is asking, why do traveling nurses have a difficult time?
Because their income varies so dramatically from job to job. So what's happening with traveling nurses is, depending on how far they go, depending on if they have to stay overnight, depending on what their travel expenses are, there's all of these, and different agencies pay traveling nurses differently. So what we're forced to do with traveling nurses is a lot more evaluation on their 2-year average. So let's say they're making a lot more money this year than they made last year. We have to average their income over 2 years. But then we also have to see like the last trend analysis. So we're always looking at W-2s, right? So if let's just give an example. If 2021's W-2 was, I'm going to use fake numbers, $100,000, and 2022's income was $200,000. Previously, we would put those two together and basically divide it by 24 months, and that's the income we would allocate. But what we're being required to do now is take a look at what their current trending pay stubs show. And if those pay stubs are declining in any way, then we have to go back to the drawing board. And any kind of decline in previous earnings is a warning sign. And in some cases, we're actually seeing that we can't prove it. So with traveling nurses, because their income can vary so dramatically month to month, year to year, if they happen to be caught in a trend of decline, it can really impact their ability to get a loan. Any more, Rach? I see, oh, look, I see all these numbers. I'm going to just open it, Rach, so you don't have to read it to me. Everybody can see me looking at it. You're welcome, Kim. It's the same with realtors because their income is based on commission. Absolutely. So Elsie, with realtors, what we need is a 2-year, you have to be self-employed for 2 years. So one, we need 2 years tax return. So if I've got a realtor friend of mine right now who's been in the business 2 years, but hadn't filed her 2022 taxes yet. And I'm like, I can't help get you qualified until those taxes are filed because she went on extension. So yeah, we're going to use a 2-year history because you guys are self-employed borrowers, right? You're independent contractors. You're writing off expenses. And if you're a realtor with that kind of income and you're thinking about buying a house, you do want to get in my hands sooner rather than later, because in this particular friend's case, I actually told her she had to stop writing off so many expenses because, of course, she was excited that she could write so many expenses off her first year, but it killed her from a qualification standpoint. because self-employed borrowers, we are using net income, not gross income. Okay, did I get everybody? Yep, looks like it. That is age, traveling nurses, and realtors. Great. Okay, perfect. Thanks, guys. Thanks for the questions. The last thing I want to talk to you about with student loans is income-based repayment. So there are people who qualify to be in what's called an income-based repayment loan, student loan, that sometimes don't know it. So typically, again, nurses, doctors, we've seen it with teachers, that if they go, oftentimes, because they're teaching or serving an underserved community, they have the ability to have student loan balances forgiven. So when we're looking at somebody with a lot of student loans, and I've seen this happen with nurses and doctors, if I will actually say to them, I had one nurse practitioner, she was carrying from Yale, she was carrying 6 figures in student loans. And I said, call, because at 6 figures, I have to use a certain percentage to qualify them. I said, call, and it was killing her from qualifying. I said, please call your student loan company, because she was in psychiatry, and we know that that's typically in New Haven. So I said, call your student loan company and find out if you can go into an income-based, it's called IBR loan. She was able to, and literally we went from having to use $1,000 a month to qualifying her to 0. So again, having a good mortgage loan officer who knows how to look at these things and give proper advice to customers on how they can qualify is so important to them. Assets. So the thing about assets is it demonstrates fiscal responsibility. So what are we looking at? What do I mean by that? We're going to look at the borrower's own funds. We're going to look at how much money they've been able to save in bank accounts. We're going to look at what they've put into retirement, other types of asset accounts, stock market, etc. And we typically require to see that that money's been there for 2 months. Okay. And so let me backtrack on a couple of things. When it comes to borrowers' own funds, one of the hardest types of assets for us to verify today in lending is cryptocurrency, because crypto does not provide statements. And if you have a borrower whose entire down payment money is coming from crypto, it can become quite a tug of war with the lender, because we have to, one, verify they had it. And that's often a lot of work that the borrower has to go through to try to show us screenshots and whatnot of what their balances were. But then secondly, they have to sell it and put it into a bank account in order for us to verify what they're going to actually net on any given day. So we won't even look at it till they've done it. Now, you talk to some buyer who's got a ton of money in crypto and they think the next month is going to be the most fruitful gain in crypto that they've seen. And I'm not making fun of them, because maybe it will. They can't get a mortgage until they've liquidated those funds, verified their existence, and deposited them into a bank account. And this can usually be a pretty prickly conversation with these people. So just know, if you hear somebody saying they've got crypto, hey, where's your down payment coming from? Do you have the money? Yeah, it's all in crypto. Oh, you need to call Kelly McGuinness right away, because we got to make sure we handle this correctly. All right, we just need to be able to get ahead of it. When I talk about the 2-month seasoning, this is really important, because with the exception of a gift from a family member, if people are coming into money some other way, they're selling jewelry and they can't verify that they owned the jewelry. I'll give you a really good example. I had a client, a buyer, who sold a diamond ring that she had inherited from her aunt. We showed a $10,000 cash deposit going into her account. She told us what she owned, and it wasn't done through a will. No, there was something that said in the will that just said all my jewelry to go to my niece. And it was so hard to verify. She ultimately, I kid you not, I Googled it and found the aunt's obituary just to see what the obituary talked specifically about this beloved niece. And we were finally able to convince the underwriter to use that $10,000. So anytime, I mean, we dig deep, guys. When we're talking to your buyers the first time, we're saying, where's your down payment money coming from? Is it in the bank? Yes. Has it been in the bank for at least 2 months? Again, you're dealing with an internet company or a loan officer who's not doing this digging, you can wind up with trouble, okay? And I don't say this to alarm you or to get you to send us your business, even though I want to do both because it's legitimate. You just want to make sure that you don't get hit on anything because we have to track large deposits. And a large deposit is different based on the person. So if you have somebody making $1 million a year and we see a $10,000 deposit, we may not necessarily deem that a large deposit because of their income, right? But if you see somebody making $1,000 a month and they've got a $10,000 large deposit, we're going to need to dig deep. And cash is, there's very few circumstances where a cash deposit is allowed. I'll give you a couple of quick examples. There are certain cultures that immigrants who come from certain cultures where they have an unreliable banking system and they don't trust banks. And so they tend to keep a lot of cash on hand. If we can verify like how long they've been at their job, how much money they make, and then they say to us, well, we've been saving, we put $50 a month in every month, and we've been doing that for 5 years. And they write a letter to that. We can see they've got the income to support it. We can sometimes get cash through, but cash in and of itself is typically very hard to verify as an asset. Gift funds are allowed from family members and now from close friends under certain circumstances. And then again, guys, this is that strategy we used before this market, seller paid closing costs. The seller can pay money towards a buyer's closing to offset closing costs if they're short on assets. Okay. And this is the calculation we tended to use. Like if somebody was short on assets, we were going to talk to you about going back and asking the seller to pay money into to help the buyer's closing costs. This is how the deal would be structured. And again, I'm not going to spend a lot of time on it. I used to go into a lot of detail on this because you were going to be using it. You're not seeing it a lot right now. But usually you say, okay, the lenders, the hard closing costs are about $5,000 a month. It's probably $6,000 now. They need 14 months of their monthly homeowners insurance, 8 to 9 months worth of property taxes. You add that all together and we take that as a percentage of the loan. And from there, we can determine which loan product they need to be in, et cetera. And the strategy usually was, if the client was short $10,000 and we wanted the seller to pay the $10,000 in closing costs, as long as you believed the house would appraise for $10,000 more, we would have you increase the sales price by $10,000, because if we were doing maximum financing on that, that might only be $50 a month in somebody's payment, $35 a month in their payment, but all of a sudden it gave them access to down payment. And we're going to talk about some of the other ways that we can find assets for customers in a few minutes, but that's basically the general approach. This will come back when we move out of a seller's market into a neutral market or a buyer's market. This strategy will come back, and that'll be the time you pick up the phone and call me and say, hey, go through that with me again. But again, we're not seeing very much of it now because it's a seller's market and the seller doesn't have to do this. And we know today sellers are looking for perfect clients to buy their house. And typically they're not really interested in somebody who doesn't have the assets that they need to buy the house. Another big thing that we evaluate is the property. Now, you guys deal with purchase price and down payment. We deal with the opposite of that, which is called loan to value, LTV. So when you're talking about somebody who's coming in with a 20% down loan, a 20% down payment, we're immediately translating that to an 80% LTV. The lower the down payment, the higher the risk. The only caveat to that is VA loans, which we'll talk about in a little bit. But typically, it's skin in the game, right? So I want you to think about all those foreclosures of the subprime loans where those people needed very little money down. They had no skin in the game. But if you have somebody coming in and putting $100,000 down on their property and they're only borrowed, and that equals a 30% down payment, okay? Our underwriting standards are going to be a little bit lighter than somebody who only can scrape together 3% or 3.5% down because they've got skin in the game. Somebody's going to be less likely to foreclose on their primary home when they've got that kind of equity. Just like right now, people are going to be reluctant. We're not seeing a lot of foreclosures right now because people are sitting on so much equity. They're doing everything they can to save the equity in that property and find ways to pay their mortgage and avoid foreclosure. So skin in the game, down payment is a big factor in how underwriting a loan goes. stricter on conventional loans right now, and I'm going to show you what the differences are in these loan programs in a moment. Conventional loans, low credit score, low down payment, very hard to get approved right now. Even though it's allowed and conventional loans allow for it, the automated underwriting systems have become very strict about it and have made it a lot more difficult on those buyers for conventional loans. And then the other thing we're going to be worried about, right? Well, two things. One is condition. We don't want to lend on a property that's in poor condition or provides a safety hazard at all to any future homeowner there. And then the other thing, obviously, we're dealing with right now are appraised values compared to what people are offering. And I do believe I have a slide here on what we call the appraisal gap strategy. If I don't cover it, somebody remind me to cover it because that's something you need to know about today. So let's talk about what a pre-approval is versus a pre-qualification. Rach, do we have any questions? I see 3 up there.
Yes, there are a couple. Can a CHAPA borrower offer an appraisal gap? Which maybe you said you were going to be getting to. Can a CHAPA borrower offer an appraisal gap? Sorry.
So the answer to that is maybe. And it depends on what CHAPA loan program they're in. Because what you have to remember is there are CHAPA guidelines that talk about how many assets you can be in your possession in order to qualify for a CHAPA loan. And so yet appraisal gap, you typically need additional assets. So we have to be careful that those 2 guidelines don't conflict with one another. So the answer is maybe, depending on what loan they're in, what program at CHAPA they're in, and how big the gap is. Rach, what's the next one?
And can you clarify whether the house needs to appraise for the purchase price or the borrowed amount?
Yeah, that's the appraisal gap strategy. Let me just get through these slides because I'm so sorry, guys. It's been a long time since I did this, and I did preview them all last night and this morning, but now I don't remember what's here. So just do me a favor. Let me get through these slides, and then trust me, we will park on appraisal gap. I'm going to get through the rest of them fast because that's an important one for you to know today. Okay. Anything else, Rach?
That's it for now.
Okay, great. So I'm going to go through this quickly with you. Pre-approval versus pre-qualification. Not all pre-approvals are the same. Not all pre-qualifications are the same. What we've seen as a recent development in today's market is a lot of good lenders, PrimeLending included, are now doing full approvals on your borrower's application up front. And so let me go through the different stages with you. So a pre-qualification, depending on who the lender is a loan where maybe the loan, it's worked up through a loan officer. Maybe the loan officer collected documentation. Maybe the loan officer ran it through automated underwriting, and maybe they pulled credit, and maybe they didn't, any 4 of those. So let me give you an example. PrimeLending, our loan officers are well trained. When we get any borrower, and our first step is the pre-qualification, we will not relay an approval amount to anyone unless we've seen the documentation, unless we've pulled a hard credit report, and I'll talk to you in a minute about hard versus soft credit reports, and unless we've run the loan through the automated system. Now, there's laws that dictate fair advertising. PrimeLending believes that a pre-approval is only a pre-approval if an underwriter has actually underwritten the loan. Meaning now the loan officer takes that loan, puts it into process, it goes to an underwriter, and the underwriter issues a commitment letter versus a pre-approval. There are a lot of lenders out there that call what I call your pre-qualification letter a pre-approval. So it's very confusing to realtors. It's more confusing to home buyers. What's really important is that you want to ask the questions. And I know good agents are doing this because I get these calls all weekend long. If a new agent gets one of our pre-approval letters on our pre-qualification letter on the weekend, which is rare now, but let's say that's the approach we took, they're going to call and ask me, did you verify documents? Did you run it through automated underwriting? What did you pull a credit report? Because they want to verify that the loan officer has done their job. A lot of other companies won't do all that, and they'll still issue something called a pre-approval. So the name on the letter is less important than the mechanics that go behind it. Today, we rarely issue a pre-qualification or even a pre-approval letter. What we're issuing is a full commitment letter, because 9 out of 10 of our new buyers get sent to an underwriter. They get completely underwritten, so that the time that your buyer is presenting an offer, we can call the listing agent and say, hey, just want to let you know, we're essentially clear to close on this client. They've been underwritten in underwriting, and all we need is a contract, title work, and an appraisal. And that is a very compelling conversation for us to have with listing agents on the weekend. So making sure you know very specifically, regardless of what it says on the letter, you want to have a conversation with the loan officer and find out exactly how much due diligence they did before they issued that piece of paper. We had a deal 4 months ago. We had to step in, rescue the deal, because the Citibank, oh, I should have said that, a bank was ignoring the borrower's calls. And when I pulled credit, I'm just going to say it, Citibank had issued a pre-approval letter and had never pulled the loan officer. So it's not Citibank, it's the Citibank loan officer had never pulled credit on file. And yet they were now in contract, and they had marginal credit, by the way. So we had to do a lot of work on this file fast to get them into an approvable state, but that whole deal could have gone sideways very easily. So know specifically what you're dealing with in the mechanics of the letter, and don't rely, guys, on just what the letter says, because there's so much legal jargon in there. Make the phone call. Call the loan officer who issued the pre-approval. And if they're not calling you back, beware. Be warned. So that's the way I would suggest that you approach this. And then a general rule of thumb I usually tell people, because you have first-time buyers that they're going to be so nervous, and this $50 doesn't hold up right now with current rates, but they're going to be so nervous about, you might be saying to them, you know what, the house is listed for $350. Everything's going to go in over ask. They were only approved for $350, and now they're worried about how much $360 is going to be. Scratch the $50 a month here and replace that with $100 a month. Typically $10,000 today is about $100 a month in their mortgage payment. And so, when somebody calls me nervous and they want to know, like, can I, I'm like, are you comfortable that if they can qualify for it? Great. I can say to them, are you comfortable with an extra 100? And if they're not, then we know that they can't go after that house. And we probably have to drop their search scales down so they can go over asking on a lower priced home. I'm going to pop up the chat here because I see it. Oh, okay. So those are still singles. All right. I this used to be a 1-hour course that I expanded to 2 hours. I'm looking at the clock and I'm like, oh my God, I can talk about mortgages, I guess, forever. So let's just go through these briefly. This is where you want to rely on a great lender. And I'm going to give you like my best pitch when we get to some of these other loans about why you need to keep an open mind. Conventional loans. These are your pure vanilla loans. These are the loans that Fannie Mae and Freddie Mac buy. You have to have good to great credit. I say 620 with a big old asterisk next to that, because remember, I just told you, we're seeing credit scores of 680 having a hard time getting approved here. But depending on down payment and other factors, it may happen. But this is what their guidelines say. That you can go with as little as 3% down for a first-time buyer. They've got a program for first-time buyers, and then they have a 3% down program for income-restricted buyers, meaning if the buyer's income, generally in New Haven County, if the total income on the file is less than $70,000 a year, then they can go into what's called an income-restricted program and get the 3% down. Otherwise, you're looking at a 5% down payment. When seller paid closing costs come back, the maximum that the seller can pay is 3% of the purchase price with the minimum down payment. And then once they put 10% down, that grows. They do have tighter qualifying ratios than some of the other loan programs. And effective in 2023, the new conventional loan amount is $700,000. And it's higher for multifamily. So let's get people talking for a minute. I told you how long I've been in the business. If you remember when I opened up my introduction, I want you to guess what the conventional loan limit was when I first got into the business. Is anybody guessing? Now I lost my chat screen, Rach.
They're all chicken.
They're what? They're chicken. Okay. So I got into the business 38 years ago, and the conventional maximum loan amount was $70,000. 70. When we went over 700,000 this year, yeah, 10%. I was blown away, just blown away that the biggest mortgage in a conventional loan you can get. Now, anytime you go over, I forwarded ahead of this. Can I go back? I don't know, Rachel, why I'm having such a hard time. I'm going to go back to the FHA in a minute. I've got to go back and relearn Zoom. Give me 1 second, guys, because I just want to go back to that FHA screen. I don't know the PowerPoint's not okay. I can do it. I can do it off the top of my head. Yeah, so it was $70,000. The second program on my previous screen, again, I don't know why my keyboard's not toggling for me. So I apologize, but I will get this out to you. So FHA loans are a really important loan. They're backed by the US government, by HUD, and they're a really important loan for first-time home buyers. And the reason that they're such an important loan for first-time home buyers is they have looser credit score requirements. You can come in with 3.5% down, and our qualifying ratios can be much higher than they are on a conventional loan. So we need FHA loans. I'm saying this to you very specifically because if you're listing homes or selling homes, I want you to hear me about this. We need FHA loans to continue to have a vibrant real estate market, which means we need sellers to accept FHA approvals. So what's happened in today's market is that FHA buyers, VA buyers, and CHAPA buyers have essentially been cut to a large extent out of the market because in a multiple offer situation, most agents and most sellers are looking first to cash and then secondly to conventional approvals. They discount, and I understand why. So again, not a judgment, it's a reality of what's happening in your marketplace. They discount FHA, VA, and CHAPA buyers. And the primary reason they do this, there's two primary reasons. One, there's a sense that people that are in those loan programs aren't well qualified. And that's a myth because if somebody is in that loan program and you've got a commitment letter from PrimeLending, let's say, they're approved, they're committed, they should be able to get that loan with no problem. And secondly, the thing that most agents, listing agents are worried about is with an FHA and VA appraisal, you have additional condition concerns. So property condition is a little bit stricter on an FHA and a VA loan. And the reason this creates some anxiety or tension with these offers is because the buyers don't want to make any repairs to the property before they close. So before this market, if somebody took an FHA pre-approval and they had an FHA buyer buying their house and there was peeling paint on the deck or on the outside exterior of the house, FHA is going to require that peeling paint be scraped and repainted, not by a professional painter. That just basically we want to see that the peeling paint's been scraped off because of lead concerns. This is only for properties that qualify under the lead guidelines, which is, you guys know better than I do, is 1978. There was a missing step, they had to replace the step. If there was a missing handrail near stairs, they had to replace a handrail. Well, in a buyer's market, right, sellers were more than happy to do this. In a neutral market, sellers are more than happy to make these minor repairs. In a seller's market, they don't want to do it. They don't want to have to do anything to the property, and they're just as soon not even be bothered. But what I'm here to tell you is, so if you're listing a house, I want you to remember me. If you're selling a house, I want you to remember me. And I want you to use this script or get me involved or one of my loan officers involved, and we will do it for you. So I had a VA client, and VA loans are loans that are offered only to veterans. And it's 100% financing. It's a benefit to our veterans who have served this country. It has no mortgage insurance on it, and it's flexible on ratios. So the VA benefit is such an important benefit to our veterans. And again, all too often right now, they're getting cut out because those appraisals are stricter. So I had a VA client making an offer on a house he loved. And when I called the listing agent, she said, well, I know it's not going to pass a VA inspection because we have some peeling paint on the deck and some peeling paint on the windows going into the basement on the exterior. And I said to her, I'm begging you. I'm begging you. I have renovation loan programs that will solve this. And if this comes back on the appraisal, your client won't have to do a thing. They said to me, I don't believe you. I said, I promise you this will work. I said, and my client's offer was the highest offer. So she finally, I convinced her, they went into contract, we get the VA appraisal back. Sure enough, the deck had to be scraped. And not only did the peeling paint on one of the windows, they actually needed to have the wood pane replaced. So my clients both were veterans. Husband was deploying to Ukraine, right when the Ukraine crisis started. And we have a renovation loan program that's called self-help, meaning the clients can do their own work. They don't need to go out and get a contractor. And we can do this on a VA loan. So I said to my client, I want you to go to Home Depot, and I'm saying Home Depot on purpose. I want you to go to Home Depot, get a paint estimate, get the wood estimate. I said, can you make the wood repair? She said, my brother can do it. I said, great. So my brother will do all the repairs. I said, great. She goes to Home Depot. They wouldn't give her a quote unless she actually bought the materials. But we didn't even know, she doesn't even own the house yet. So I said, the heck with Home Depot. I asked the client if she trusted me. She said yes. The next day was a Sunday. She called me on a Saturday. I went to Lowe's. I walked in. This poor little guy in the paint department didn't know what hit him. And I said, do you want to help me help a veteran buy a house today? He got his manager over. We got the quote. The loan closed perfectly fine. They did the repairs post-closing. And who do you think that listing agent now sends all her deals to? Me. Because I promised her it was going to be okay, and we have a solution. So if you're seeing as a listing agent, FHA pre-approvals, especially if they're from PrimeLending, most importantly, if they're from PrimeLending, because we have so many renovation programs, I want you to pick up the phone and call the loan officer who issued the pre-approval letter, because chances are pretty good it's not going to have any impact. Chances are very high. We can solve it without any concern to your seller, okay? So that's my pitch for VA and FHA buyers today. We've been largely cut out of the market because of the concern over appraised values and appraisal conditions, but it's important for you to know. Chattel loans, again, I'm not going to spend a lot of time because I really want to spend time with you guys on the appraisal gap stuff. Chattel's getting a lot of publicity right now because of their time to own program, which is up to a $50,000 grant. They're very difficult to get through. There are very few properties that qualify for them, but when it works, it's a wonderful thing. CHAPA programs are geared, they're state of Connecticut funded programs that are geared to low to moderate income home buyers. You must be a first-time home buyer. There are maximum household and income gaps by town. All household income needs to be included in those household caps. They allow for down payment and closing cost assistance up to 105%. They're using a second mortgage. They package the first mortgage either conventionally or FHA, and they use a second CHAPA mortgage to cover the down payment and up to 5%, up to the additional 105 on closing costs. They're very strict on their ratios. And what's really important for your buyers to know when they go into a CHAPA loan is that they cannot retain that CHAPA loan in the future if they intend to move out of it. And that's really important because I've taken too many calls over my career where CHAPA has foreclosed on properties that somebody left and kept as an investment property, or the house needed. I literally had a case in 2020 where we had to rescue a CHAPA loan because the person bought a 2-family house, had planned to live in one unit, remodel the second unit. When they started remodeling the second unit, they found all sorts of environmental issues with the property. They couldn't even stay in the property while the renovations were being done. It was a long project, and CHAPA was starting foreclosure proceedings because they weren't actively living in the house. So really important program, really important today because it helps people with assets, and we know affordability is such an issue, but you have to know what you're getting into with a CHAPA loan, and people just have to be really clear about what those restrictions are. Only a few minutes, I'm going to talk about these. USDA, not a lot in Connecticut, but we do have pockets. There's some homes in Durham. I found a home in North Madison once. 100% financing for rural areas. The funds have to be approved by Congress each year, and it's not uncommon for the funds to run out before the end of the year. So if you've got somebody, that's up to the lender to determine whether this is a program. I told you I run the whole Northeast. We do a ton of USDA loans in Vermont, New Hampshire, Maine, upstate New York, very popular programs. I think in Connecticut, our Connecticut offices probably write 1 or 2 a year. So not something you're going to come up a lot with, but and it has to be, we have to look it up by the actual address of the property. But when we find one and it works, it's a beautiful thing. Jumbo loans, this is wrong. It's for loan amounts that are over that $700,000. Okay. So jumbo loans are where we go when the loan amount exceeds the conventional loan limits. They are very strict today because they are held to an even stronger ability to repay rule, and even more onerous ability to repay rule than any of the government agencies are held to. And it's completely different guidelines by investor. So when we work with about 15 to 20 different jumbo investors. When I tell you, like, we have to roll up our sleeves and make sure this loan works, because different investors have different guidelines. So as realtors, as you're evaluating jumbo pre-approvals, you want to know that they're not all created equal, okay? And if you see something from a jumbo lender that you've never heard before, chances are pretty good that jumbo lender has some guideline that they've decided to put in as a safety measure or a risk measure on their particular loan programs that other jumbo lenders might. The guidelines are completely different by jumbo investor. Renovation loans, guys, this is not real popular in this market right now. I do a presentation that I'll be doing again in the fall, which is called how to create more inventory for your millennial buyers. There's a way to use renovation loans to help buyers in today's inventory crisis. I'll just tell you quickly, it allows for the remodeling and renovating of properties. Buyers today are more open to renovation loans, millennials, because they've been watching Joanna Gaines and Chip Gaines on HGTV and the whole HGT phenomenon. So where before we had generations of buyers who really didn't want to deal with it, today's buyers are more open to it. It's a solution to the inventory crisis. The greatest example I have is I had a client who wanted a colonial. She saw a cape that checked all of her boxes, but she really needed extra square footage and she wanted a colonial. So I ran all the numbers for her that if she closed on the cape, she went out and got some real quick quotes because she had some friends who were contractors. We could do a renovation refinance after she closed to turn her cape into a colonial. And we did. It was right here in Wallingford. And the woman, I'm not exaggerating, she calls me every year with another renovation project she wants to have happen. So renovation loans are a great solution. They're also a great solution, as I said to you before, for our VA and FHA buyers who we may see some appraisal mandated property condition repairs required. And again, we shouldn't be shying away from them. So, I'll let you guys know. I'm going to have all your emails when I'm running that next how to create inventory for millennial buyer workshop. I'll send you all an invite, but I would encourage you to get on that presentation to learn more about this strategy. Chat. Now I have the chat. Let's see what people are saying. DPA info to remembering the rate book. Yeah, Barbara, the rate booklets all those years ago. Oh my God. Down payment assistance. So the main down payment assistance program that's available in the marketplace is through CHFA loans, the Connecticut Housing Finance Authority. Some large banks and lenders like Bank of America, and I think Liberty has one too, have started offering their own specific down payment assistance programs that you have to basically look at those specific lenders. Then you've got municipal entities such as the Living City Initiatives in New Haven, which will help buyers in New Haven get down payment assistance. But typically, I'm just going to give you like some fair notice. Typically, the down payment assistance through municipalities is backwards. So here's where the rub is. Like Living Initiatives in New Haven, you have to have a contract and a clear to close from your lender before that client can apply for the grant. And then the grant takes 30 to 60 days to get after that. So in today's market, we're seeing the municipal down payment assistance programs really being a disadvantage because sellers aren't willing to wait for all of that. And most lenders are not willing to issue a clear to close until we verified that the grant has been given. So it's kind of like a backward situation, but that's typically, Christine, where you're going to see down payment assistance programs. And a check of borrower rent if they live at the property also. If it's a multifamily property, the answer is yes. Okay. All right. I have, oh my gosh, I've got 18 minutes for this, I think. All right, guys, ready? First, I want to give you this slide to talk about before we get into this, I want to talk about where interest rates are because it's a big topic today, right? Interest rates are trending high 6s, over 7 today. I'm sure everybody heard the news that the Fed increased the Fed funds rate by another 0.25% yesterday. What you have to understand is there's not necessarily a correlation between what the Fed does and where mortgage rates go, except that the mortgage markets have been incredibly volatile, trying to predict what the Fed's going to do and trying to predict when we're going to get these economic issues under control. So the most important thing for you to know going forward is what to say to your customers when they talk about how high interest rates are. Now, here's the scripting that I want to give you. Interest rates were low during the pandemic. They were artificially low during the pandemic. The government didn't know what was going to happen to the economy with a global health shutdown. And so they started pumping money into the economy in the form of lower interest rates. The other way they started pumping money into the economy was they were buying they were buying all the mortgage-backed securities to prop up the mortgage securities market. The only other time that the government did that in history was during the subprime mortgage crisis. Now, that doesn't mean we relate back to the subprime mortgage crisis. It's just the second time in history the government used that strategy, but for a completely different reason. Now, what's important for you to understand, and I can send you a graph when I send this out, is that mortgage rates follow inflation, period. So what do we have right now? We've got record high inflation. We've got inflations like we haven't seen since the 70s. Does anybody remember where interest rates in the 70s, the last time we had high inflation? I do. I started in the business in the 80s when rates have started to come down a little bit. They were 17, 18%. You were excited to get an adjustable rate at 14% because inflation was so high back in the 70s. We have high inflation again today. The Fed is artificially raising rates right now to stem inflation. If we were looking at all the current economic indicators, mortgage rates would not be as high as they are. But the Fed is using it as a tool, a tried and true, according to them.
Yeah, I just signed back in.
Hi, Ron. A tried and true rule to try to bring inflation under control. And what are the three markets that have been red hot since the pandemic? Real estate, employment, and now inflation and the cost of goods. So I'm here to tell you that today's rates are artificial. We thought that perhaps we would see them coming down at the end of this year when the Fed got inflation under control. That looks like it's taking a bit longer than anyone forecasted. So the current rate forecast by most leading economists is that we will see interest rates come down somewhere between the end of the first quarter, early into the second quarter, which is essentially right during peak spring season, right? Now, why is that important to you? A few things that I want you to be aware of. Number one, I keep saying to people, well, bringing interest rates down is going to bring more buyers into a market and we need more homes to sell. But we don't have a shortage of buyers right now. What we have is a shortage of homes to sell. But there's been a lot of interesting data that's come out from the National Association of Realtors and the Mortgage Bankers Association that says some buyers who are feeling rate locked in their homes, meaning they look at what a housing payment's going to be at their current rate of 3% compared to moving up or moving down at rates at 7%, and they're staying put. There's a lot of publicity about this in the media. It's not as big a percentage as the media would have you believe, but it is a dynamic in the market, right? It's a dynamic that we need to address because it could potentially help us in our current market condition. And what the data is starting to show is that the MBA and NAR are saying that most sellers are reporting that if rates came into the middle fives, they would reconsider selling. And that actually happens to be where the forecast is for rates in the second quarter of next year. So with luck and, and with good economic policy that works, we are hopeful that we'll see interest rates trending in the direction that some sellers are reporting they would consider selling at, thus creating more inventory. And then you come to, so that's kind of where interest rates are trending. When you hear that, if you hear anything on the news that says that inflation is starting to come under control, that's a foreboding that mortgage rates will start to improve, okay? Number one. Then you want to look at the media and the impact that they have on, should we wait to buy? There's another housing crisis coming. There's another housing bubble. And I love this particular slide because it demonstrates for you like the impact the media can have on our industries and the really negative impact that they can have on our industry. So in October of 2015, this happens to be one economic news reporter, and we picked up quotes of hers through the years. She said in 2015, a bubble larger than 2006 is about to hit. Well, in 2015, home prices nationally, I'm going to make this correction for you in Connecticut in a moment, nationally corrected, went up 5.1%. That's $15,000 based on a median home price at that time of $300,000, $15,000 in equity. 2016, we're in the new housing bubble. 5.4% home prices went. 2017, home ownership doesn't build wealth. Prices nationally appreciated 6.1%. And then you see where the trend is, okay? So if somebody is being put off by the fear of the media, pick any year here, you can plug and play the amount of wealth and equity that they lost by waiting. And what we do when we talk with a customer who's afraid of buying now because of interest rates and property values, we'll actually look at what the appreciation forecast is in Connecticut. And we will talk about how that offsets to a current interest rate, given the belief, which is the most common belief out there. And I know there are some naysayers and so you may be some on this call, and that's fine too, that most people are going to be in a position, anybody who bought in late 2022, throughout 2023 are going to be in a position to refinance for significant savings if/when, but I believe when rates come back down into the middle fives. So this is a nice demonstration for you to talk about with people about how much money, where else over a 6-year period could the average American household have picked up that kind of wealth? Okay, from 300,000 to 523,000. Now, what's important to understand about this, about Connecticut, and especially for those of you that are new, those of us that are older will tell you, Connecticut was the last state in the country to come out of the equity collapse of the subprime mortgage crisis. We ranked 50, number 50. We did not experience any appreciation in Connecticut until the end of 2018. The end of 2018. I would get these charts from Freddie Mac that would show all the equity appreciation, all the appreciation going around the country. Literally, 49 states in the black, and Connecticut would be in a little bit of red because we lost 1% that year. We lost 2% that year. And that went on for 5 years straight. The end of 2018, we started picking up appreciation again. So when you're looking at housing prices in Connecticut today, and back then, let me just tell you what the hot buttons were, right? The hot buttons were that we had pensions that were underfunded in Connecticut. We taxed pensions. People were retiring. We had a population exodus out of the state because all the people who had pensions were moving out of state, okay? And therefore, property values were stagnant. That was the reason that most politicians and real estate experts put on why Connecticut was not surging. What happened during the other big prediction back then was nobody was going to want to buy the little McMansions, the 3,000, 3,500 square feet colonials that they've been raised in because they wanted to live in the cities. So what happened during the pandemic? Think about how quickly something that happens in the world can shift what's going on in our industry. Pandemic comes, work shuts down, people flee the cities. I dealt with a lot of buyers who were coming to Connecticut from New York, Boston, and Providence over the last 4 years, and they're continuing. Now, there's talk about they're going back to the people are coming, returning to the cities. That's true. But what we're finding as the millennial buyers are starting to start families, and as more and more percentage of people are remote working, they need larger homes, which are not available in the cities because husband and wife both need a work at home office. And if you guys work from home like I do and my husband does, you know what I'm talking about. So this shift in the population and the work dynamics of the American workforce has created this pressure on real estate that Connecticut has actually benefited from. So when young buyers ask me, do I think we're going to see a collapse? I always go with two things. One, the unemployment numbers of the subprime era versus today. And two, the fact that Connecticut was the last state in the country to come out of the housing crisis relative to equity, where other states, I'm getting very passionate about this, where other states had already experienced big appreciation. So yes, are we seeing property values drop in Miami? Probably. In Phoenix? Probably, because they had double-digit appreciation in some years that we didn't. Nationally, 15, 16, 17, 18. Look at those appreciation years. Connecticut was 0 or in the negative. So I'm not concerned about Connecticut home prices right now. I am concerned about the combination of home prices and interest rates as it affects the average Connecticut resident's ability to buy a home. But when it comes to is there going to be a collapse? This is my humble opinion based on economic and data. I think we're probably going to be okay. I see a couple questions. For luxury properties, loan finance jumbo. Well, luxury, so what's the Elsie, what's the definition of luxury? You know, if it's selling for like over $1 million, then yes, certainly we're going to be looking at jumbo loans. What tags to a jumbo loan is the loan amount. So anytime somebody needs a loan of $700,000, over $700,000, they're going to be in a jumbo loan. We know a lot of luxury properties in Connecticut are selling for cash right now. We know that sometimes, you know, buyers of luxury properties can come in with sizable down payments. They may not need a jumbo loan because they might only need $700,000 and go conventionally. So that's really going to be dictated by the amount of financing. Okay, so I think I got everybody there. Yeah, 18%. You're right. Okay. This is the one I want to go to for you guys. This is the nope. This is a 2-1 buy down. Oh goodness gracious. Okay, I'm gonna put us back on screen. Stop sharing. Hi everybody. Can you guys see me when I'm presenting, or is it just the screen? You can see me too, so you saw all my animated faces, and when I was like, okay, I didn't know that. I was like, is this just the screen they can see? Rachel, I probably should have asked you that a while ago, huh? Well, that's good at least, because you can see I'm into it, right? All right, before we get to the appraisal gap strategy, I want everybody to unmute themselves and tell me if you have any questions, any comments, anything you want to review. Come on, I know somebody's out there.
You can
No,
push down your space bar to temporarily unmute.
I'm learning a lot again for the second or third time. I've been doing this, I don't know, 13 or 14 years, and just knowing where the market is now and where the mortgages are now, it's been very insightful for me. So thank you.
You're welcome, Christine. You're welcome. I know it changes every day. That's why people say to me, how have you been doing it so long? It's like, it's different every year. Different job every year. And the same for you guys too. The same for you guys. All right, so I don't have a slide. Shame on me. I don't have this is important for you today. So I'm going to insert it into the PowerPoint that I'm sending you guys on the appraisal gap strategy. But let me talk to you about it in theory, and then I'll give you a couple of succinct examples when I send you out the presentation on Monday, okay? So is there anybody here who does not know, and I really want you to be honest and conversive with me right now. because this will make me feel like my 2 hours of talking are worth it. Is there anybody here who doesn't know what I'm talking about when I say appraisal gap? Please be brief and tell me if you don't know what that means.
I have a slight understanding, but I'm not completely sure of the exact meaning.
Jill, you're my favorite. Thank you for speaking up. So
You're welcome.
what an appraisal gap strategy is what's going on in today's market, right? We've got record appreciation. Home prices are going up. If you think about how an appraisal is done in the mortgage industry, we're looking at data that's 6 months old, right? So this was especially a problem. When I tell you appraised value was the bane of my existence, all of our existence, you know, middle 2020 straight through middle 2021, and then it started calming down a little bit. But we do see it today, and here's where we see it. So back then, we were just having a problem keeping up with the rate of appreciation, right? Homes were appreciating, but the 6-month data hadn't kept up. I called a meeting with all of our appraisers, and because our appraisers work directly for, they don't work for PrimeLending, they're independent contractors, but we have our own panel. We don't farm that out to, and I said, tell me what's reasonable for you guys to be using as, you know, a market trend analysis to add back in for timing on some of these comps. And they came back to me and said, lenders won't let us do it. And I said, well, that's other lenders. We will definitely let you add back in for current market appreciation. And they came, you know, they all basically came up with the same number. And from then on, we were one of the few lenders that was able to actually get properties to appraise or closer to appraising than our competition, because we were taking the market adjustment for appreciation. So if a property sold 6 months ago was the last comp we could get, then we could literally add additional monies for every month because of appreciated home values. That's number one. But what's happening today is home price appreciation has stabilized. It's still happening, but not at that record pace. What's the challenge we have today? I'm not going to say it. I'm going to sit here until somebody says.
Houses are selling for a lot more than their appraised value.
Right. So here's the conversation that goes on with listing agents, right? Every once in a while, I'll get a call from a listing agent and they'll say, I can't believe your property didn't appraise. I'll give you an example. I got this call on a property that went $100,000 over asking, $100,000 over asking. And listen, I understand the frustration everybody has, but here's what I say to the listing agent. This house was on the market for 4 days. It went $100,000 over asking. You set the price at the price. I'm presuming that you did a comp analysis and determined that's what the house was worth at that given time. The fact that the buyer has decided to pay a premium on that house is not necessarily reflected in appraised value. Does everybody agree with that? Correct. Now, it's certainly a buyer's prerogative to offer more money on a house, but it's not the requirement of the lender to lend on it if the house can't be appraised for that amount of money, correct? Correct. So let's say you have a buyer coming in and they're putting 20% down. They have a nice down payment, 20% down, and the house under appraises, okay? And the buyer does not have the extra cash. If they have the extra cash, which happens quite often, it's easy because all they have to do then is put the extra cash in to make up the difference between the appraised value and the sales price, and we all move on with our merry ways. And I'm shocked at how often that happens. You know, it happens a lot more often than I would have thought. People are willing to take loans against their 401ks for this. People are willing to tap into family members for gifts. People have the extra cash that they can put in. So if they can make up the difference on their own, great, problem solved. If they don't have the money, or they don't have access to the money to do it, or they don't want to tap into their 401k, we as a lender have to work with you as the realtor to see if there's a gap strategy we can deploy using the dreaded PMI. PMI is mortgage insurance. For some reason, we've had mortgage insurance around as long as I've been in lending, but the internet must have grabbed hold of the millennial buyer because they hate mortgage insurance. They think it's like the devil has come back and is robbing them of their money. And they also, I've had people say to me, I'm not buying a house till I have 20% down, I'm not paying mortgage insurance. So I pull up that slide I showed you with the appreciating values real quick and talk about how the $50 a month in mortgage insurance is a penny compared to the appreciating values they're going to get if they invest in real estate today, right? So you've got to be able to make these comparisons to some of these misinformed or irrational thoughts that our buyers and sellers have today. So if we have a customer putting 20% down And let's make the numbers easy. It's $100,000 purchase price. So we're going to get an $80,000 loan. We're going back to like 1984 with these numbers, but you know what I mean. So $100,000 purchase price, $80,000 loan. They do not need PMI. The house appraises for $90,000. Okay. They don't have any extra money to put into the house. We can help them in one of two ways. And it's all going to depend on what their down payment originally was. Because our calculations to determine maximum loan amount and maximum loan to value is the purchase price or the appraised value, whichever is less. So now the house you're selling for $100,000, I can only lend up to 95% on $90,000. So when we run our calculator here, $90,000, the minimum down payment is 5%, right? $4,500. But we've got a delta of that other down payment they were going to come to closing with. So the solution for them is to do one of two things, is to either add your traditional mortgage insurance, which will cost a certain amount of money each month, depending on credit scores. This can be as little. I've put mortgage insurance this way on loans for the appraisal gap strategy. That was $27 a month. So for $27 a month, you get to keep the price where it is. You get to buy the house that you want. Is it worth it? Knowing that the mortgage insurance is required to fall off once you get to 20% equity in your home. So that's money they'll get back depending on when they make up the equity in the home. The other strategy is to use a one-time PMI premium, which can be as little sometimes as like $900. So instead of now having to come to closing with an extra $10,000, they only have to come to closing with $900. And I've seen cases of this where the sellers have contributed the $900, although we know that's not likely, but I have seen it happen in this market where they split the $900. Hey, the house didn't appraise, but we still want to make sure we're not going to come back and renegotiate for price, but hey, will you give me, $450 or $1,000 off so I can pay for the mortgage insurance? And we see sellers sometimes doing that. So by using, now, where is this not available? Where does this not work ever? Is when we're dealing with a buyer who is getting maximum financing, right? They have no room. We have no room to increase their loan amount, okay? And either increase their mortgage insurance or add mortgage insurance. So this strategy does not work for people with coming in with the minimum down payment, which is why you'll hear resistance from listing agents. I'll hear resistance saying, yeah, you've got a good offer, but they have a minimum down payment and I'm not sure the house is going to appraise. And those two things together can create some tension in your negotiations. And they should, because there isn't a solution to that. So, I recommend becoming experts in learning how appraised value is determined. Do a really great job when you're presenting offers and looking back at the content on appropriate comps or not. Make really good friends with some appraiser, a real estate appraiser out there, so that you can become really proficient. I have one agent with a large company I do business with. She'll call me and say, and I do a lot of business. We did 100 loans with her last year. And she said, she'll say to me, we're going to go in at 350, but I know it's going to appraise for 322. And she's right every single time. I mean, I'm telling you, the woman has studied how to determine appraised value. She doesn't delude herself. It's so easy when you're looking at comparable sales. Well, it's almost a 3,000 square foot. Well, it's kind of a similar, you don't want to be doing that. You want to be ruthless in how you're looking at this so that you can manage your customers' expectations going forward. Because that's really what we want to do, is make sure you preserve your clients, right? How many of you have had buyers who've made 4, 5, 6, 20, 25 offers over the last, we've got clients that have been pre-approved for 2 years. They've made offers on dozens of houses and they're not getting them. Usually minimum down payment clients, right? So that the key here is making sure you can manage expectations appropriately based on where you believe you can counsel them the house is going to appraise. Does that help? Does that answer it? Jill, did that give you more info? All right. So look at that, 12:06. I ran 6 minutes late. I thought I was gonna run early. I could talk about mortgages all day. So we're gonna send you out a copy of the PowerPoint presentation. I hope you found today valuable. I'm gonna also put you on our email list, and anytime there's a new hot topic in mortgage lending, trust me, I'm not gonna bug you. I'm not gonna be saying to you, send me a loan, send me a loan, send me a loan, but I do hope you send us a loan. But what I am going to be saying, I'm going to introduce my team to you so you have our contact information. Because again, as in this new role, I'm not actually doing the mortgages anymore, but I've got a great team of people who do. But secondarily, I'm only going to send you updates like, when the loan limits increased at the end of last year and went over 700,000. I sent a quick video to everybody who'd been in my Mortgage 101 class, because you've demonstrated an interest in mortgages, right? Which means you probably want to be kept up to speed. So I'll keep you up to speed on changes and things you should be considering, or new scripts maybe you should be using as we see them working in the marketplace. And then you're always free to reach out at any time, and we're happy to help in any way. Any questions? Any last questions?
That's
Thanks.
it. Thank you so much, Kelly.
Thank
Great.
you. That was great.
Thank you, Kelly.
You're
Thank
welcome,
you.
guys. Have a great weekend.
Thank you.
Thank you.
Thanks.
Thank you, Kelly.
You're welcome.